talk about the T-bill market first. Fairly active T-bill market. Bond market, however, still dull. Are we seeing certainly a similar picture of what we're seeing in the equities market, where investors are sitting back? I mean, what's your take?
Hi, Uche. I think it's a combination of both. Typically, towards the end of the year, you see a bit of reluctance to initiate new positions in terms of asset and portfolio management. But overall, you probably will expect this kind of shift from the fixed income in the fixed income space, from out of the 20 years into the 1-year T-bills, comparing yields and effective yields of this instrument in terms of the duration and the likes. You find that putting some activities in some portfolio shift in the 1-year bills at this time might actually be some good portfolio strategy, and as a result you've seen a bit of lackluster activities in the bond space and a bit of increased activities at the T-bills market. I think like I said, a combination of both. Investors not really willing to initiate new positions at this point in time, shifting strategies, changing the portfolio yields at all would actually account for such activities that you've seen across the curve. But overall, we still think that interest, the appetite for the fixed income space in Nigeria still is a bit healthy.
It's still healthy, Eze. But certainly, I'd like to find out: do you expect these investors to keep these positions till the end of the year, or do we expect some surprises like we saw in the equities market today?
Well, overall, you might see some liquidations of positions at that, but I think it will still be countered in a way by some new initiation of positions, not really as much as I think you will have a fairly balanced move in the fixed income space over the course of the end of the year. I really don't think you'll see any shocker in terms of rate direction or in terms of price movement for the fixed income market across the curve of this thing. That's the way I look at it. I say you see a flow, inflows, you see some outflows, and that would be fairly balanced.
Right. Well, certainly I want to know then, as your expectations for Thursday's 128 billion naira offer in T-bills. I mean, you think interest is still there, so certainly you must think that we're going to see this auction being oversubscribed.
I think the interest is still there. I think, in a sense, the interest is relatively reflected in the price of the currency. If you take a snapshot of what the currency has done this week, opening at 157.28, closing today at 157 on the handle, that obviously shows some flows that come into the market outside of the typical oil flows that we're seeing, and that gives it an indication of where the interest lies. Overall, I think that the yields are going to come out a touch softer than where they did at the last auction. The market's trading at a very healthy levels, but the secondary indicators on the 1-year space actually shows that we think that the yields will obviously come out a tad softer than it was in the last auction.
Right. Yields a tad softer there. Now, Eze, I'd just like to get your picture on some news we received today. We heard that Fitch Ratings has actually withdrawn the position they had on River State proposed 100 billion naira 5-year fixed rate bond, because realistically, River State never actually came out and issued this bond. What's your take on this, and certainly the overall outlook for the domestic bond markets? I mean, we had thought that with all the activity in our bond markets, certainly that was a good picture for our corporate bonds and our subnational bonds going into 2013. What's your take on where that sector is going?
Well, these kind of reactions or these kind of actions by the rating agencies just simply tells the issuers and the investing community also that the spotlight is there and everybody's out to do serious business. All expectation concerning any issuance should be adhered to, and the likes. I don't think it's a negative thought. I actually think it's positive. It just means that there's a need for everybody to be on top of the game in this asset class. Overall, I think that the national bond space is emerging. The corporate bond space is emerging. I think interest would actually continue to grow, albeit not maybe not dramatically, but overall I think it should grow with the tendency of the yields and what it will portray over the coming year. I think it becomes an attractive outlay for people to do. If people had looked at the few corporates that went into the bond market in the last year and the year before, and the yields as we made those issuance, those were fantastic insurance yields for the issuers of those corporate debt, and I think people are just waiting at the right time to actually enter the market. So I really don't think it's a negative, I just think it's positive, because it just shows that people that are sitting out about to give this actually should be on top of the game, and people are watching also.